Okay, then I think it's time to start this webinar. And I also see Natasha, one of our speakers, just joining, who will hear from a little bit later, so that's great. Okay, everybody, then I just want to say welcome to this webinar hosted by WWF. I want to make sure that all of you are aware that we are recording the webinar, and we will put out the link for everybody who's interested afterwards to take a look on it. We also will share a presentation that has been given in this webinar. So don't be afraid if you miss some of the key points. For every spring, WWF here in Norway has one activity we know that we are going to do. And that is that we're going to preoccupy with Equinor's General Assembly, and also what we are going to do about our one share that we have in Equinor. And this year, we are have been looking more into Equinor and its plans on the energy transition, how we see the company, and also what we think shareholders should know about Equinor's plans. So we have invited all shareholders and others with interest in the company, of company's operation and investments, to an open webinar because we want to shed light of Equinor's plan and also to discuss what kind of company Equinor should be in the future. Because Equinor is a very important company, just not just for us here in WWF-Norway, but for the Norwegian country. So every year we are discussing what kind of future the company should invest in and how are we making sure it happens a little bit faster maybe than the company wants in itself. Over the last couple of years, though, we have also seen that much more external interest is coming to Equinor from other countries, both in terms of environmental organization, who are questioning the exploration plans on oil and gas from Equinor in various parts of the world, but also other shareholders discussing and looking into Equinor's plan and how they are investing or de-investing from oil and gas and what is their plans in renewable energy. And we in WWF Norway keep on challenging Equinor to be more ambitious, to take more action, and that is of course our role. But what is really good to see is that a lot of more other stakeholders is coming on board and asking the same questions. So in this webinar today, we will present some findings that we in WWF have been doing, but we will also hear from other shareholders in Equinor and how they are looking at the company, but not at least also hear a little bit from Equinor on what they think about our findings and our views. And we will have a panel at the end where we are having some questions to the panelists and going to have a conversation about both the findings that WWF have had and others, but also what kind of future can shareholders, how can they make sure that we invest in the future we want from Equinor as well. So we have a tight agenda, so I just want to pass the word over to Guro. So Guro is a senior advisor in WWF Norway. She will present a summary of an analysis we have conducted by WWF Norway based on data from Røed Energy, looking at Equinor's energy transition plan and the profitability of Equinor assets in a 1.5-degree scenarios, meaning that if the worlds are reaching the goals from the Paris Agreement. So with that, I just give the floor to you, Guro.
Thank you, Ragnhild, and thank you to everyone for attending our webinar. My name is Guro, and I work as a senior advisor at WWF Norway. And I'll go through some of the results from a report that we have recently launched about Equinor's energy transition plan and profitability in a 1.5-degree world. And since we have limited time here, we will send out the full report to all attendees afterwards. And I would encourage you to look at the full report as well, in addition to what we present here. So, the reason why this is important to look at now is that if you look at all of the 1.5-degree consistent pathways, there are actually none of them that are giving any room for new oil and gas investments, either in new fields or in new explorations. So to limit global warming, which is to below 1.5 degrees, which is essential for all of us, there should be no new oil and gas investments in new exploration or in new developments from this point onwards. Furthermore, in order to enable an energy transition into renewables, there is a large investment gap in solar and wind that we need to fill. So research from the International Institute for Sustainable Development suggests that this is an annual gap of $450 billion a year until 2030, while at the same time they estimate that it would be spent over $570 billion in new oil and gas development and exploration. So investors and energy companies have a challenge to move money away from new oil and gas exploration and over to renewables. And the reason why it's so important to stop investments before they are started is that the timeline for a typical oil and gas field is very long. So if you invest in an oil field that is discovered now, it would take 10 to 15 years before the production starts, and then it could take additionally 10 to 30 years with production. So we would be way beyond 2050 when the world needs to reach net zero. For a conventional oil and gas field, there is usually a high upfront investment before production starts, but then when the production starts, the variable cost is quite low. So for an investor who might be taking investment decisions based on the wrong assumptions, if the oil price drops, they would still have an incentive to continue oil and gas production. So this would mean a huge carbon lock-in for the future years, but also the risk of increased stranded assets because several of the oil and gas producers would then supply too much oil and gas into the market, which would then make the oil price drop. So WWF and Greenpeace, we have submitted a proposal to the annual general meeting of Equinor, and we asked the company to set targets and implement measures in line with the target to limit global warming to 1.5 degrees. And we want these targets to be including the entire value chain, which means also scope 1, 2, and 3, and that this reduction should mean an absolute reduction in greenhouse gas emission. So our proposal is quite similar to the wording that is stated by the expectations of the Norwegian government in the new white paper for state ownership, where they also ask companies to set targets and implement measures to reduce greenhouse gas emissions in line with the Paris Agreement. And they state that the targets should be science-based when available. So even though the Norwegian state is the majority shareholder of Equinor, the board of Equinor has still recommended the shareholders to vote against our proposal on the annual general meeting. So if you see the commercials from Equinor, you might be conceived to think that the company is taking the Paris Agreement seriously and that they are in line to reach a net zero target in 2050. So these are the climate targets of Equinor, and I want you to draw attention to point 2 here, which is the target about reducing the net carbon intensity with 20% by 2030, 40% by 2035, and then net zero in 2050. So the net carbon intensity equation is actually quite complex and entails a lot of different components, but it basically means all the emissions that Equinor is responsible for divided on the energy production. So the issue here is that in the energy transition plan, there isn't enough information for us to actually deduct how Equinor will reach the different targets in 2030, 2035, or 2050. This year, compared to last year, Equinor has stated that for oil and gas production, they plan on stay on the same level in 2030 as they are now in 2022, which means that they would have to reach the 20% reduction by other means, for instance, by increasing renewable production or hydrogen production, or just by purchasing offsets, for instance, into carbon sinks. So what we have done is that we have taken all the assets in the Equinor portfolio and then estimated the cumulative emissions from the scope 3 from all of these assets and added it between 2020 and 2050. And then we've also added the black line here, which is an SBTi pathway coming from the Science-Based Target Initiative, which is what the Norwegian government wants its state-owned companies to be aligned with, here in the graph as well. So what it shows is that if Equinor were to only perceive or continue with its current fields that are producing or under development, the company would actually be aligned with a 1.5-degree pathway. But if they decide to make any new investment in oil and gas projects or in new exploration, they would surpass this pathway in 2050. And as Equinor has stated that they plan to continue the same production level in 2030 as in 2022, this would actually mean that they would exceed a 1.5-degree pathway with 75% in 2030. In their annual report, Equinor presents a portfolio stress test to showcase how robust their portfolio is towards other price scenarios, which is more in line with the Paris Agreement. So the yellow line here is the base case price assumptions for Equinor. So they expect a future oil price of $75 per barrel until 2030, and then a gradual drop towards $65 in 2050. And compared to other oil and gas majors like Shell, BP, Total, Equinor has the highest and most optimistic price assumptions of them all. So in their annual report, Equinor states that compared to the APS scenario, which is another IEA scenario, announced pledges scenario, they expect actually the value of the portfolio to increase with 17% compared to their base case scenario. But if you look at the graph, this doesn't make much sense because the price assumption is actually lower than Equinor's own price assumptions. So there might be some information here which Equinor hasn't disclosed, but when we try to replicate it, we end up with a result, a negative result, which makes more sense given what they have actually disclosed of information here. And then if you compare with the net zero emission scenario price assumption, which is a 1.5-degree aligned price scenario, Equinor reports that the impact on the portfolio would be a reduction of 22%, while we actually find a reduction of 43%. And again, there might be reasons here, information that Equinor has not disclosed, which makes up for these discrepancies, but we would urge Equinor to provide some more background into how they reach these conclusions for the portfolio stress test, given that the results differ quite a lot. So what we have done is that we've also implemented our own stress tests using the Røed Energy database. And in this stress test, we use 4 different price scenarios. The first is the yellow one, which is the Equinor base case. And the orange here is the Røed Energy base case scenario. And Røed Energy, for those who don't know, it's a very renowned consultancy and analyst company which is especially used by the oil and gas industry. So they have a lot of knowledge of the oil and gas industry. And they actually expect the oil price to drop towards $35 per barrel in 2030, which makes, because they expect demand to drop while production stays quite the same. So there will be an oversupply here, which then results in lower oil prices. So depending on who has the most right here, Equinor might risk taking too optimistic investment decision based on a very high expectation of the future oil price. In addition, we are using two other price scenarios, the IEA price scenario as it is reported by the IEA, and a flat oil price of $30 per barrel just to use as a baseline stress test. So these are our findings. So when looking at the portfolio, if you look at the producing assets and fields under development, there is a low risk of stranded assets. And this is basically because most of these assets have been paid back already since the investment was made a long time ago. But there is still a risk of quite potential loss in earnings here if you look at the low price scenario with a 51% reduction in the IEA net zero emissions scenario and a 75% reduction in the $30 per barrel scenario. So, but then if you look at these two other categories, this is all the discoveries in the Equinor portfolio, and this is the estimated resources from all its exploration licenses. And I should state it's not likely that Equinor will develop all the discoveries or search for oil and gas in all of the assets, but this is to give a complete picture of the portfolio and the entire risk of the portfolio. And also for undiscovered assets, of course, this is hard to estimate because you haven't actually discovered any oil. So this is based on a best guess resource estimate from Rystad Energy. So if you look at the discoveries, the expectations from Equinor based on its base case price assumption is quite high. But then if you look at the Rystad base case, the potential earnings drops with almost 50%. And then in the two low oil price scenarios, the return on the investment is actually negative in both of these cases. And what I should add here is that in addition to having very high price assumptions, Equinor has also a very low discount rate. So they use only a requirement of 5% real rate of return after tax, which is at least something I would consider quite low. For example, if you compare the Norwegian government require a 7% real rate of return on all the investment on the Norwegian shelf. And as a base case assumption, Rystad Energy, they use 7.5% as a discount rate. So as an investor, there is a potential risk here of Equinor making investment decisions into new discoveries and also for exploration activities that might be too optimistic for the future oil markets. So as an investor, what you should probably consider is that given that the world is moving towards a 1.5-degree scenario, or we have to move there, which means that oil and gas investments would be a risky decision. Maybe it would be a better use of your money to either invest this money into solar and wind power, or just pay out as dividends to its shareholder instead of Equinor taking these decisions on behalf of its shareholders. So that was all I had in this time, but unfortunately, there's not much room for questions. But I'll send out an email afterwards with the report and then you can also contact me for comments and questions afterwards.
Thank you, Guro, and we may drag you into the conversation if needed during the panel for a very specific question. There's also a couple of ones in the Q&A, so you can take a look at them and answer them in writing. But then it's my privilege to welcome the next speaker to this webinar, which is Natasha Landell-Mills, who is a climate risk expert and head of stewardship at Sarasin and Partners. And for those who don't know Sarasin, that is a global investment company that also is an Equinor shareholder. And she will go through their assessment of Equinor ahead of the annual general meeting. So with that, Natasha, very much welcome to you, and I give the floor to you.
Thank you. Can you hear me okay?
Yes, we can.
Perfect. Great. Well, thank you. And that was a fabulous presentation. So thank you for that and the introduction and for having me here to just say a few words from a long-term investor perspective. I wanted to kick off with a quote. Many of you will probably know it very well. It's from Ernest Hemingway's novel, The Sun Also Rises. And it's a short exchange between two of the kind of key characters there. How did you know you'd go bankrupt the last? 2 ways, Mike said. Gradually, then suddenly. Now, no company ever expects to go bankrupt. I think that should be quite self-evident. I don't think SVB did, and I don't think First Republic, which you may have seen, also went cap in hand to the government just the day before yesterday. So no company is ever intending to do that. But I think the point is that you get these transformational moments, these non-linearities in the economics of different sectors, which can lead to insolvency. And I think probably the role of investors, and this doesn't just apply to the oil and gas industry, I think this applies much more broadly to carbon intensive industries, which are facing precisely that kind of transformational situation. It's the role of investors to be challenging management and asking them to pivot as quickly as possible to a cleaner future that's sustainable, rather than doubling down and investing in past activities. So we've heard a lot already from WWF's great analysis around why capital is at risk. So I hope what I say is very much complementary to that. I think the analysis is spot on. I would just maybe contextualize my comments so by saying, look, there are 2 aspects to capital protection when it comes to long-term investment, in my view. There's a macro perspective, which is that 1.5-degree alignment is vital for capital protection across the economy, and therefore to pretty much all of our holdings as investors. It's otherwise often referred to as a universal investor perspective. So the essence of this is very much that it makes no financial sense in the end to profit from causing harms in other parts of the portfolio. I think that's a really important point. The second aspect is the one that we've really been focusing on here, which is the micro perspective. So specifically for Equinor, capital is, in our view, at risk from their slow pivot towards net zero, and therefore not aligned with the 1.5-degree scenario. So I'm going to take the first point about the macro perspective as read. I think we all understand the risks to the economy and to the world from climate change, and focus more on that micro perspective that we've been hearing about. And in essence, I guess our view is that in not aligning its strategy with 1.5 degrees, Equinor, rather than being more cautious and adopting a precautionary approach, which they've talked about, a balanced approach, we believe this strategy is actually quite risky, not just risky for the planet, but also risky for shareholders. We've had statistics on continued investment into oil and gas. We had in the latest annual report and accounts actually quite a useful figure that really encapsulates this. The addition to Equinor's oil and gas exploration and production assets, specifically their plants, property, equipment, intangibles, and equity, that actually rose 11% in 2022. In contrast, despite apparently investing more into cleaner energy, the equivalent of that number for renewables fell 35%. So in terms of where capital is being deployed, it still remains very, very heavily into fossil fuels, so the doubling down that I mentioned before, and not so much into the cleaner energies of the future. Now, the problem with this CapEx is, of course, that it is very long-lived, 15, 20, 30 years, and it's being deployed at a time of accelerating demand destruction in the fossil fuel sector. Now, demand destruction is not just, I should say, happening as a result of government policies. We know that government policies are actually well behind in terms of promoting 1.5, but they are there and they are accelerating. But also because of the clean technology revolution that we're witnessing. And some of the figures that the IEA has been coming out with, that's the International Energy Agency that's been coming out with recently, just evidencing that transition, are really incredible, in my opinion. So they published a report at the beginning of 2023 on the global power sector. It's an annual review that they've done. And in that, they demonstrated that the entire increase in that year in demand in the power sector globally was met by investment in low carbon power. Furthermore, they say that low emission sources are set to cover almost all the growth in global electricity demand by 2025. So you're really seeing an incredible pivot towards clean power. Likewise, if you look at the EV market, I think they put out a report a couple of weeks ago or so that says that EV car sales are set to leap 35% this year to a new record. So they're constantly having to revise their predictions for the rollout of these cleaner technologies because they keep getting it wrong. They keep underestimating the rate at which the world is pivoting towards these clean energies. Rystad is predicting peak oil and gas, or has predicted peak oil and gas, but really interestingly, BP in its latest energy outlook, so the oil and gas major, has come out and said that in fact the peak was hit in 2019. Often the Russian invasion of Ukraine is used as an excuse or a reason why actually this transition needs to slow down. What the IEA has been demonstrating and producing reports about is in fact quite the opposite is happening. If anything, the Russian invasion of Ukraine has sped up the transition, not slowed it down. Again, underlining the concerns that we have as investors over continued capital deployment into fossil fuels at a time when the demand is just shifting away quite quickly. So why is Equinor pursuing this strategy? Very quickly, this is something that we talk about a lot, and then I'd invite you to come look at our vote for Equinor's 2023 AGM, which is on our website, where we go through this in some detail. But essentially, we think part of the reason that Equinor is continuing to deploy too much capital into fossil fuels is because they're driven by their accounting numbers, the financial statements. And those financial statements incorporate a number of assumptions which are overly optimistic. Oil and gas prices, we've heard about from WWF talking about how those look high relative to their peers, and certainly much, much higher than anything that would be consistent with a 1.5 pathway. But I would also draw your attention to a few other things. Really importantly, they don't give us disclosures on this, but it seems that they're assuming no changes to the production outlook of all of their assets, and their asset lives will not be curtailed. So the production assumptions also are not at all consistent with that picture of declining demand. The asset retirement obligations, so the liabilities, the cleanup liabilities that they will need to meet in the distant future when those assets are closed down. Again, that's a distant problem they don't need to worry about because they're assuming the production will continue in the similar vein that it has in the past. Also, their plan to use more CCS, carbon capture and storage, is not costed properly as far as we can see. So it's a really key part of them continuing to do the high levels of production, but it's not being fully costed in their impairment testing. And in our view, the cost of capital that they're using in the accounts is too low. It's not reflecting the elevated and rising level of risk associated with both the decarbonization transition, but also the physical risks that we're going to see more of. So overall, what we've got, in our view, is a set of numbers which are too optimistic, and then that leads to excessive investment or reinvestment into fossil fuels. We've heard that Equinor itself talks about how its own NPV, net present value of its assets, would actually fall 22% in a 1.5 scenario, which again just tells you that if you have an accelerated transition, its capital is at risk, and that should really worry investors. And I would agree with WWF, the key areas of risk are really in their international businesses, where they're building new infrastructure, et cetera, which will be long-lived and potentially impaired. A brief mention also that something that worries us is potentially an underlying assumption on all of this, that they can continue their production and they will be able to meet their net zero goal, because when they get further along, let's say 2030 afterwards, they'll just be able to sell those fossil fuel assets. The problem is many of the other oil and gas majors are presuming exactly the same thing, and trying to sell lots of assets into a declining market never ends well. So that concerns us somewhat. It also is slightly ironic, since today Equinor seems to be arguing against sales of their profitable fossil fuel assets, because that just shifts production to others. Well, to do the same thing in 5 or 10 years is exactly the same problem. It's just shifting fossil fuels elsewhere. It's not decarbonizing the planet. So why are we invested in Equinor, you may wonder? Well, we actually do see Equinor as a potential leader. We think that it is showing a real interest in decarbonization and thinking very hard about how they can manage that transition. Critically, the government of Norway is 67% shareholding, and we believe that this gives management and empowers management to actually do a 1.5 pivot in a way that many of the other oil and gas majors could never do, and we would definitely support them in doing that. You may see that we, along with many other investors, wrote to the Prime Minister of Norway actually in January, offering our support for Equinor to pursue a 1.5 aligned strategy. So the government here, we think, is a very important player, and we're very keen to support them in ensuring that Equinor can play the leadership role that we believe they should. So I'll end there. I'm sorry, I hope I haven't gone over time, but very happy to take questions later.
Thank you, Natasha. And then I invite, of course, Hilde from Equinor, who has been mentioned quite a lot of time, what we would like to hear from the company. And Hilde Røed is the Senior Vice President for Climate and Sustainability at Equinor. And we have asked Hilde to give a couple of comments before we open up for more of a panel conversation. So Hilde.
Thank you,
a lot of things thrown at you.
Yes, thanks, and thanks for the interest in our company and our transition plan. So we very much value the dialogue. I'll talk briefly just about our energy transition plan, which has been mentioned quite a few times, and then touch upon the stress test and the difference between the stress tests that we report in our annual reports and the analysis that Guro just showed. But just very quickly, wanted to explain sort of our main approach to the energy transition, because for us, really, our main aim is to deliver energy and reduce emissions, and do that in parallel. And as our energy transition plan has been mentioned here several times, and this is really where you find our long-term, but also our short and medium-term ambitions within climate. And we were very happy to see that 97% of the shareholders at our last annual general meeting voted in favor of the plan. So a clear sort of vote of confidence there. And key in this plan is really that we need to balance the role as a trusted energy provider with the need to accelerate transition. And of course, with that comes all the risks and opportunities and dilemmas that we have to handle in that transition. The transition plan includes both our short, medium and long-term ambitions, but it also describes our strategy for how we think we can play a role in the energy transition, in line with limiting global warming and in support of the Paris Agreement and the goals there. And we have three main lines of ambitions. The first one is to reduce our own Scope 1 and 2 emissions by 2030 with 50%, while maintaining the oil and gas production at approximately the same level as today. And we've also said that we will achieve at least 90% of that ambition through absolute cuts. So we've also effectively put a cap on the share of carbon credits or offsets to be used. So I see there's sometimes some confusion around that, but a very clear ambition there. Then we've also said that we will allocate more than half of our capex to renewables and low carbon solutions by 2030, and reduce the net carbon intensity. And that includes Scope 1, 2, and 3 emissions. And our aim is to reduce that by 20% by 2030 and 40% by 2035. The reason we have an intensity-based ambition is because we believe that this is a more meaningful approach to Scope 3 emissions than just absolute cuts, because this actually entails both the renewables, low carbon solutions, and oil and gas. So it covers the entirety of our company, and it incentivizes investments in energy, and it includes both the energy and the emission side. And we strongly believe you need to handle both at the same time. We've just launched our progress update, so you can see how we're doing on these ambitions. We've achieved 31% on our Scope 1 and 2 ambition since 2015. So very good progress there. Last year, we invested 14% of the capex in renewables and low carbon solutions. So a very clear step up from 4% 2 years earlier. And related to this is, of course, the two very clear milestones we have of increasing renewable capacity to 12 to 16 gigawatts, or producing around 40 terawatt hours of renewable energy by 2030, and the 5 to 10 million tons of CO2 storage ambition we have. And these are important because they are how we plan to reach our net carbon intensity ambition in 2030. So if there are any questions as to sort of how we plan to reach it, it is really through these renewables, CCS, and the emission reduction ambition, where we have very clear milestones towards 2030. When it comes to the stress testing as such, I think we've read the analysis with interest, and important for us, of course, is to have a strategy that is resilient in various scenarios. And this year we integrated our sustainability reporting and the stress testing in our financial report. So we have an integrated annual report, and it's also externally audited. And we test against the net zero scenarios. We also do an impairment testing against low carbon scenarios in the same report. I could go on in detail about this, but I think some of the key differences with regards to Equinor's versus WWF's analysis lies here, because we can see from reading the report that sort of the applied price paths that are used, particularly in the short term, we don't have any price points in the scenarios until 2030. So the next couple of years are different in the two analyses. The calculation assumptions differ, the discount rate differ, and also the portfolio composition differs. So they are actually written under very incomparable assumptions. And it seems like the WWF report is written under the assumption, which is the wrong assumption, that the impairment sensitivity and this net present value stress test are directly comparable. They are not. They're two very different types of analysis, because the impairment testing only includes the sort of produced and sanctioned assets and related to the balance sheet, whereas the net present value stress test looks at sort of the overall value in future cash flows. So they're two very different analyses, and I think that's some of the explanation for the differences. But for us, it's important to stress that in addition to doing this portfolio analysis, we think it's equally important that we evaluate every individual investment based on both value and climate risk. So we use carbon pricing, but we also use low carbon price scenarios when we test each project. And the robustness of our portfolio, I think, is really demonstrated by the fact that we have a break-even target for the oil and gas projects of $30 in the sanctioned portfolio and $35 in the unsanctioned portfolio. So those are maybe the key numbers to look at. And of course, also
Hilde?
a lot of CapEx flexibility. So I think that's sort of the main sources for the difference, and hopefully something that can take us into the panel discussion.
Thank you, Hilde, and sorry for rushing you, but we have a limited amount of time. So then I want to invite Natasha back on the screen, and I also want to welcome our final panelist, which is Arild Skedsmo, who is a senior analyst for responsible investment at KLP, and KLP is Norway's largest pension company. And Arild, you have been listening into both Hilde, Natasha, and Guro from WWF now. And how does your company look at kind of the energy transition plan and future investments of Equinor? Because you're also a shareholder in Equinor.
Yeah, thanks, and thanks for a lot of very good information from and presentations by both WWF and Natasha, and the comments from Hilde. I think a lot of the issues that we look upon are covered by the points made by Guro and Natasha. But to add a little bit on the transition plan as the main topic here, from our, I mean, as KLP, we both believe we have to and will reach a low carbon society. And for us, the long-term systemic risk is really at the top of our mind when we are looking at these transition plans that all the major oil and gas companies produce in one way or another. It's important for us then to stress that this is supposed to be a transition plan from going from one place to another, and not just doing more of something, but also actually doing less of something. And I guess that's the main concern we have with Equinor's plan, that as Hilde also describes it, production levels remains more or less constant, at least up to 2030, and it's not clear what happens beyond 2030. And then it's they have a target on intensity instead of absolute emissions. And of course that works if everybody, or if someone else takes down their production proportionally higher, but it doesn't work if all the oil and gas companies think in the same way. So that's the main concern to us.
Yeah, thanks.
Then I have to add one more point.
Yeah.
And that's sort of the main thing that we're looking at in the portfolio is their long-term capex investments, and we are very concerned when we see that investments are made in new fields and in frontier areas. I know Guro had a slide that she didn't have time to show now, but a very useful map by WWF pointing to their international portfolio and the new areas where that are far from the established infrastructure, and that's sort of where we our main emphasis in our dialogue with Equinor, that we are concerned about this sort of long-term investments where capital is locked into in production that will only happen very far into the future.
And that brings me over to you, Natasha, because you mentioned that in your also previously, but the financial risk of investing in new oil and gas project, which is not able to deliver before many years from now, when we are hopefully also in a different world. How do you see that from your point of view?
Yeah, I mean, I would just say that that's the heart of the issue, isn't it? It's that, you know, we're kind of kicking the can down the road and thinking, you know, I think the way we put it in our public statement on the vote, it's sort of carbon today, transition tomorrow, and that kind of approach is just very, very risky in our view, because if the prices are not what we anticipate, right? And we're talking about the IEA saying, I don't know, $30 or so, Rystad saying $30 or so. But, you know, it was just a couple of years ago that oil prices went to zero. You know, I mean, that's a kind of estimate, but it's not going to be right. And the difficulty you have in an S-curve environment, and by that I mean where you have kind of slow transition and then you have very, very fast moves to new technology as the economic tipping points have been met. And I think we're basically there. We're already, you know, seeing that renewables, as I mentioned, EVs, you're starting to see it elsewhere, that you can have very sharp price moves in the oil and gas market. You know, you had a, you know, 2 billion shift in oil and gas out of 100 billion annual market, and prices halved, you know, a few years ago. I mean, so I think the financial risk is very much that we're investing, as we've heard already, in very long-lived assets on the basis of an assumption on a price, which is highly, highly uncertain. But what we do know is this is a sunset industry, and declining sunset industries will see a lot of volatility and therefore much more risk. So I should think right now is a moment to be super cautious about reinvesting, putting to one side the whole planetary consequences, which of course, you know, are important to think about too.
Thanks, Natasha. And Hilde, so kind of since your energy transition plan was launched last year, kind of we see at least no surprise that environmental NGOs once more and kind of much higher ambition from Equinor. We also see now that larger investors is coming, but also that we have even stronger message from the IPCC, so the UN climate panel, kind of saying it's more urgent than we thought from before. And we know that the prices is going up and down and it's hard to predict and everything. How ready is Equinor to actually then maybe discussing some alternative routes in kind of compared to where you are now in your energy transition plan?
I think it's definitely been a very, you know, special year for everyone. I think and also in the geopolitical context and also with the tragic backdrop of the war in Ukraine. I think what we see is, of course, the climate crisis is as urgent as ever, and the need to transition fast is there, and we see some signs of regulatory and, you know, policy developments going in that direction. I think we've also seen during the last year how important energy as a commodity is, and energy security, and really it's sort of the need to balance these and to build out the alternatives. So the fact is that 80% of the world's energy system is based on molecules today, and we need to get away from that. But I think where we have probably differ in opinion also from Natasha is the speed of the transition. You know, how fast can you possibly do that? I think we can do a lot, and I think we can do a lot fast, but it's still, you know, a very big job that needs to be done. For us, it's important to ensure that we continue to produce the oil and gas that there is demand for in the most responsible way, while building out these alternatives. And that's really where you see the growth, and you see that in our CapEx ambition and the renewables growth. But I think building out the alternatives and also having a discussion around these sectors that are difficult to electrify. How do we sort of solve for those with CCS, with hydrogen, etc., to have a sort of maybe more pragmatic discussion around that. That's what we see also from a lot of investors. So I do hope we use this moment in time to accelerate transition. But I think we've seen sort of that we need to do that by solving both the climate and the energy security issue.
So Arild, on that, so in Guro's presentation from WWF, she also showed us a graph explaining kind of how we need to move money away from fossil fuels and over to renewable energy. And Hilde also touched upon that we need to more investments in to scale up that. So how do we make this happen? And what do you need from Equinor to make this happen? Because we know that is not going fast enough.
Yeah, I think the major thing that we are asking from an oil and gas company is not to put their capex into a long-term oil and gas production. That's sort of their primary responsibility. And then it's great if they can come up with a good business strategy that explains how they will be investing in renewable energy production. From an investor point of view, it doesn't have to be Equinor who does both. They can pay us back the money, and we can invest that in someone else. So that's for Hilde's team to prove that they have good opportunities and a credible business case also for renewables. At the moment, I don't see really cash being the main challenge in renewables, but someone has to come up with the projects and initiate them. And I think investors, long-term investors, are willing to put money into renewables, and I'm sure we will continue to do that as well from our side as well. But we can't do both. It's a transition from one energy source to another, and that's what we have to stress now.
Thanks, Arild. And Natasha, so kind of you have your own suggestion for the AGM, and I'm pretty sure you maybe didn't vote for the energy transition plan last year at the AGM. So what do you need to see in the financial statements and other resolution at the AGM, Equinor's AGM, to vote for them and believing that this is the path going forward? Because acknowledging that it is a transition.
Of course, it's a transition, and Hilde is exactly right. It's about the speed of that transition and the willingness to trade off kind of, I would say, planet security over getting the fossil fuels out, over a longer time frame. So what would we like to see? We'd like to see Equinor publish a bolder transition plan, one that is 1.5-degree aligned. We think they can do it. And actually, we think with the government support, 67% shareholder, then we should all be aligned, actually. And this is not easy. This is a challenge, but it is possible. And so that's what we'd like to see. We'd like to see a bolder transition plan that's 1.5-degree aligned. And as we've heard, it doesn't need to, we don't know now. That is up to management to set out, whether they invest in cleaner fuels or whether they give the cash back to shareholders. But a wind down strategy is also potentially quite an attractive strategy from a shareholder perspective.
Thanks. And now you have other meetings to attend at 4, so we have to close down. And so I just want to thank you for your participation today. And we will send out, of the course, recording and report and presentation from Guro. But I also want to stress that the Norwegian government, they has recently launched a white paper on ownership. And what they're asking for there is companies to set and implement targets in line with the Paris Agreement, which is then 1.5-degree target. And the targets should be science-based when available. And then you have the Science-Based Target Initiative, which is the one that covers Scope 1 and 2, 3 to show you're on a path. So I think we have that opportunity and moment now from the Norwegian state to actually do this in practice together with Equinor. And since the Norwegian state is the biggest owner of Equinor, I'm hopeful that we will see some changes in the transition plan going forward as well. So thank you so much, Hilde and Arild, for attending, and Natasha, who just left, and Guro, of course, for her presentation.
Thank you.
Thank you, everyone.